into the content so we can stay on track here. So, so this all starts with, come on, slide, move. There we go. Here's where we all start. You know, this is all about businesses. We are in pension season, which means that employers who are having a good year might like to have a better year, because if they're having a good year, so is Uncle Sam. The more they make, the more they're going to pay in taxes. I've been doing this for a very long time, and I've yet to find a business owner who would like to pay more taxes. They'd usually rather pay less. And one of the great ways to pay less is to adopt a qualified plan. Those plans have to be adopted by December 31 for those companies that are on a calendar year. And so we are in pension season. So it's time to talk to business owners. You know, are you having a good year? That's great. Let's turn a good year into a great year by helping you keep more of what you're working so hard to earn. So those that are making the money and that are profitable, I don't know where my slide just went. Okay, I don't know what's happening to slides. Why is it jumping? I apologize, that's not me, that's the slide. What do they do? Companies who are profitable and are making a lot of money, they're usually looking for ways to kind of write that off and hide it as income at the end of the year. They spend the money. You know, successful business owners tend to have really nice toys, nice boats, nice cars, nice houses. They hide the money in whatever creative ways they want. They look for deductions. You know, they'll do improvements to their business. They'll buy equipment, things that will get them a deduction on their return. Kind of beyond that, they may do a SEP. SEPs are very common for small businesses, or maybe a simple, and their accountants will help them set up those plans. But a true qualified plan may be able to do much more for them, and also give them more control. And very few businesses in the small plan market actually have plans, and my personal belief is not because they shouldn't, but because no one's talking to them about it and they don't know how to do it on their own. It's a little more complicated than that, which provides a great opportunity for you. So here's looking at a corporation who's profitable. Now, any business can do a qualified plan. They don't have to be a corporation. Any form of business will do, but let's say this is a sub-S corporation and they've got profit. They've got $50,000 of profit. You know, how might they take that money out? If they take it as a dividend, so they let it pass through, let's say they don't put it on their W-2, they let it pass through, that's profit. At a corporate tax rate, that means that $50,000 will be taxed at 34%. So now we lose $17,000 to taxes. We're left with $33,000. Once it passes, then now it's subject to ordinary income tax as an individual. So I'm using a 28% tax rate here. They might be in a higher rate, but at 28%, there goes $9,240 to income taxes. That leaves them with $23,760 in their hands from that original $50,000. Let's say they invest that money and earn a 7% return. Well, that's taxable as well. So using that same 28% tax bracket, that nets them a return of 5.04%. So let's say we did that every year for 20 years. At the end of 20 years, they would have $828,740. Not bad. But let's change how we define that money, and let's pay it as a bonus rather than letting it pass through as a dividend. So now the company gets to actually deduct it as payroll. So there's no corporate taxes. So now, you know, that business owner gets to the full $50,000. Again, subject to income tax now because it's income. So at 28%, they lose $14,000 to taxes. They're left with $36,000. We invested in the same 7% return, but again, that's taxable, 0.04%. Now, at the end of 20 years, we've got $1,255,668. Way better. Same $50,000, we just recategorized how we use the money. So let's look at the qualified plan option. Now we take the $50,000, let's put it into a qualified plan for them. Any kind of plan, just some kind of qualified plan. There's no corporate taxes. In fact, there's a deduction which we're not reflecting here, but no corporate taxes, no personal income taxes. So now we get to use the full $50,000. We invest in that same 7% investment, but now we get the full compounding on the full 7% because we don't have to pay any taxes. We do this for 20 years, and now we've accumulated $2,193,258. Now, we do have to pay tax. This is not tax evasion, it's tax advantage. So if we took that all out and we paid using the same 28% tax rate, I don't know what the tax rate will be in 20 years, but I'm going to use the same tax rate. I paid $614,411 in taxes, and I end up with $1,578,847. So it's the most efficient way to accumulate money. So for that business owner who's got that $50,000, who may not be taking advantage of that option, you know, would they rather end up at the end of the day with $828,000 or almost 1.6? We're almost doubling their results over 20 years just by going to a qualified plan. So let's talk about baby boomers for a second. They're a sweet spot here. We've got 80 million of them out there. The average 401k balance for someone in their 50s, look at that, is $117,000. So these are not just the employees, but the business owners as well. This is the average, and my experience has been just because the business owners make more money doesn't necessarily mean they save more money. Sometimes they do, but lots of times they don't. So again, if you're talking to that business owner, they're having a really good year, they're paying all those taxes, losing all that tax money when they could be keeping that money. And add to that, you know, they're thinking about retirement, maybe, you know, how much do they have put away? If they fall into this average category, $117,000, and a lot of the balances will be less than that. They may have more, but how much do they need to retire? For example, if we do a defined benefit plan for someone like that, we could accumulate $2.5 million for them in a qualified plan. That may give them a big jump up on their retirement planning. So for most of those business owners, where is the money going to come from to retire? Most of the time when you ask them, the answer is they're going to sell their business. Well, that's nice, but what if they can't find a buyer? What if the economy is poor at the time that they want to sell? Most business owners also tend to over-evaluate what their business is worth. They think it's worth more than it is because it's worth a lot to them. So what if they can't find a buyer who will pay them the amount of money that they think it's worth? So what happens to your retirement plan if any of those things happen? Now you end up with a business owner who's in a position who has to either choose to lower their lifestyle and take what they can get, or maybe they don't get to retire. They're going to have to keep working till, you know, as long as it takes, 5 years, 10 years, 15 years, I don't know. Don't know what that end game is going to be. But if that same business owner in the good years had put money away in a qualified plan, they would have benefited from the deduction at that time, benefited from all that tax-deferred growth to accumulate a large sum of money, and now, when they're ready to retire, they actually have some choices. So maybe they can't get what they want for the business or sell it today, but maybe they could still retire and sell the business down the line, or sell the equipment from the business down the line and still be able to retire because they've got this other pot of money that they can use. So let's look at what is the economic value of the contribution to that business owner. So here I have a business owner who's making $175,000. That puts them in a 29% federal marginal tax bracket. So that would mean they would pay $50,750 in tax if they have that net tax of $175,000 in income. State tax would be on top of that. So let's use that $50,750. If they did that for 25 years, you know, let's say they're 40 and they're going to retire at 65, that's $1,268,000 in taxes they're going to pay over the next 25 years. So let's instead put in a qualified plan. Sorry, the slides are delayed. Okay, and put in, this year we could put $54,000 into, say, a little solo K plan, a little one-person plan. That would save them $18,900 in taxes this year because of the deduction. So if we did that over 25 years, and again, I'm just assuming tax rates don't change, dollar numbers don't change, we're just going to put that $54,000 in every year for the next 25 years. If I multiply out that $18,900 of tax savings, that's $472,500 we saved in taxes that we got to put to work instead of paying in taxes. So I'm assuming here a 5% growth on that money. I don't really know what's going to happen. Let's assume it grows at 5%. This is just that tax savings, the $18,000 and change. In 25 years, I'll have $937,000. Now, I have to pay tax when that money comes out. But, you know, pick a tax rate. I don't know what the tax rate is going to be. I'm going to say, let's say 50%, because I always like that number because it makes the math easy. So on $937,000, I'll have to pay, I don't know, about $460,000 in taxes. So let's say I lose half of it to taxes. I end up with about $460,000 in my pocket. Versus if I hadn't done this at all, I'd be out the $472,500 in taxes. So I'd rather have the $460,000 than have paid $472,000, and that's just the tax savings. The rest of the money is working for me as well. All right, so let's talk. So why do a qualified plan? Obviously, the tax savings is the big driving factor. You know, 100% of the contribution is tax deductible to the business. None of it's taxed as current income. The growth on the money is tax deferred. And we can also have life insurance in here to generate tax-free death benefits on top of that as well. So lots of good tax reasons to put the money away. It's a tax-advantaged way to do it. But there are also retirement reasons. Here you could do a qualified plan and accumulate a substantial amount of money for retirement. We can put in guaranteed retirement benefits if we do a fully insured plan or a defined benefit plan. Protection from creditors. If you have one rank and file employee in there besides the owner, all the money in that plan is fully protected from creditors. No one can get at that money except the IRS. They write the rules, they go where they want, and your spouse. Other than that, no one can get at that money for any reason. We can have after-tax Roth accounts and a 401k if that makes sense for somebody, so you can have some money pre-tax and some post-tax. And we can also do very efficient asset transfer. Now, qualified money is the worst money to die with, honestly, because at death it's all subject to income tax and estate taxes. But there are ways we can distribute that money prior to death where we can get tax advantage as well. So we get tax deduction up front, tax advantage distribution, and we can leverage that money into greater benefits using the benefits of life insurance. So tax deductions up front, tax deferred growth along the way, tax advantage coming out, and then future tax-free benefits can be a very good combination. All right, so it's pretty easy when it's a one-person business, but the question is, you know, I have employees. I don't want to put money in for my employees. I don't want to contribute for them. Well, we do have to include some employees. We can't ignore the employees. The IRS lets us get deductions for qualified plans because this is an employee benefit. But we don't have to cover everybody. We don't have to give everybody the maximum. And this plan is designed around you, the business owner. We will do our best to get at your objectives, save you taxes and get the money going to you and keep that cost for those employees to a minimum. You know, that will be our goal when we're designing a plan, unless the business owner tells us they have a different goal, and we'll go to that goal. And the key is to get the plan efficient, and if we can get the plan efficient, those employees don't cost anything. So let's look at a little sample case. Here's a small business. We have Pat and Chris who own this business. Their child, Drew, is in the business with them, and then they have 2 employees. So, you know, what can we do for this business? Well, here's a nice little profit-sharing plan that we could design for them. We can get Pat and Chris each $54,000, which is the maximum we can give them this year. Drew gets $56,39, but look at those 2 employees. We're only putting in $2,250 and $1,500 for those 2 employees for Pat and Chris to get $108,000. So let's look at what this plan really costs. The total plan contribution to this for this plan for everybody is $117,389. The tax savings for that, we're using a 34% tax bracket here. Because of the deduction, it saves them $39,912 in taxes. So their net after-tax cost for the plan is only $77,477. Of the $117,000 contribution, the family here is getting $113,639, because we're only giving that small piece of contribution to those two employees. So if the net after-tax cost is $77,000 and they're benefiting from $113,000, they're coming out ahead $36,162 by doing the plan. So the other way to think about this is their deduction, they're saving $39,912 in taxes that they would have otherwise had to pay. Of that, you know, the $3,700 or whatever, $3,750, whatever that number was, is going to their employees, and the rest of it, $36,162, is going to them. So they're way ahead just by doing the plan before they've even invested the money. If they don't do the plan, they're out of pocket $39,912. They don't get to keep that money. They have to pay it in taxes. So yes, we have two employees in this plan, but it's not costing the employer anything for those two employees. In fact, to not do the plan and cover those two employees, that costs them $39,000. So the plans we have to choose from, come on slides, be cooperative, there we go. On the defined contribution side, right, these are plans that define how much we can put in. We don't know what will end up at the end. Those would be mostly profit sharing and 401k plans. Then on the flip side of the coin, we have defined benefit plans. They define how much benefit we'll get. Here, under defined benefit plans, if there's no limit on the actual contribution, it can be whatever is needed to fund those benefits. So we have the advantage there of being able to make very, very large contributions. And then we have IRA plans, you know, which are funded with IRAs. Those would be SEPs and Simples, where the money goes right into an IRA. Here's our little group back again. So let's look at what plan design can do. So here's our same little group. Here's a SEP. This would be a very common plan that would be put in for a group that size. You know, lots of times done by their CPA when they're doing their taxes. I want a deduction. Okay, put in a SEP. Nothing wrong with SEPs. But look at how the numbers fall in the SEP. To give Pat and Chris their $54,000, everybody gets the same percentage of pay in a SEP. So Drew gets $15,000, but employee 1 now gets $9,000, and employee 2 gets $6,000. So we have to put in much more money for the two employees for Pat and Chris to get their same $108,000. Now they could do a simple. I swear I'm only hitting the key once. I don't know why the slides are doing this. Okay. There we go. All right, so we could do a simple. A simple is a 401k lookalike that is an IRA. So here they could each do their salary deferral. This year it's $12,500. The employees could choose to defer or not to defer. It's up to them. Pat and Chris can also do the catch-up, which is $3,000 in a simple plan. They would get a match. There's a required match in a simple plan. So now they would get $23,600 apiece. You can see Drew there as well. And they only have to do a small matching contribution for the two employees. So this is a very small expense for the two employees. But, you know, are Pat and Chris satisfied with $23,600? If they are, then this may be fine for them. But if they want their $54,000, they can't do it here. So let's step into the world of the true qualified retirement plan. And what do we get when we go to a true qualified retirement plan is we get more control. So these are under a different section of the Internal Revenue Code than the SEP plan. So it gives us a lot more options. We can choose who's in the plan. We can choose how much people get in the plan. We have a vesting schedule so that employees have to stay with the employer in order to vest in their benefit. And we have protection from creditors. That same protection does not run to SEPs and Simples. So on our defined contribution plans, so we said these are the plans that control how much you can contribute. There are limits. The most any one individual can get in a plan year is $54,000. The maximum annual contribution from the employer that the employer deducts is 25% of the total payroll of everybody who's in the plan. If it's a 401k, it also has salary deferrals in there. So this year the limit on salary deferrals was $18,000. Plus if you are eligible for the catch-up because you're 50 or older, that's another $6,000. Those amounts, that $18,000 salary deferral counts towards that $54,000 total. The $6,000 catch-up could lay on top of that, so someone could actually get $60,000. Those salary deferrals do not count towards the 25%. employer limit, so you could have a salary deferral plus a 25% contribution. But no matter what, you cannot get past that $54,000 or the $60,000 if you're 50 or older. So here's our group. Again, let's look at what the plan design could look. We know on the one on the upper left, the proportionate to pay, that could be a profit sharing plan, or that's exactly what the step would look like, where we've got $54,000 for Pat and Chris, and you see there the two employees, one's getting $9,000 and one's getting $6,000. If we go to the one on the right, this allows us to take into account Social Security, because the employer makes contributions to Social Security, but it doesn't benefit people in retirement who make over the wage base. So we're allowed to take that into account, and what it enables us to do is give a little boost to those people making above the wage base. So here we can't boost up Pat and Chris, but it lets us lower those two employees a little bit down to $7,463 and $5,096. Not dramatically less than the proportionate to pay, but a little bit. It would save the employer a couple of $1,000s. If we go to the one on the lower left, this is age-based. And here we can sway our contributions based on people's age and pay. So now we're able to get employee one down to $1,988, which is great. We were originally at $9,000. But look at employee two is age 60. And that drives employee two's contribution way up to $23,031, where before we were at $6,000. So the employer probably doesn't want that. So we go to new comparability, which is the one on the lower right, and here is where we're able to get Pat and Chris each the $54,000 and get the contribution for employee one to $2,250 and employee two to $1,500. So this is clearly, and you can just look at the pies, the most efficient design for Pat and Chris if their goal is to benefit themselves and to give as little as possible to their employees. And this is what plan design can do. And keep in mind the one on the upper left, that's what a step would look like, and you would find a lot of businesses out there that look like this that have that step. So if given the choice, they'd probably rather have that new comparability design. They just don't know how to get it. You can bring it to them. All right, so, but what about those who want to do more? We can do more. If you could see the slide, you would see that it says that. We can do more, and the way we do more is to go to a defined benefit plan. So for those who are older, a defined benefit plan will generate much larger contribution. For someone who's 30, not necessarily, but someone who's in their 50s, we will get much larger contribution. So here's a comparison. Here's a 55-year-old. So if we did a profit sharing plan, we could contribute $54,000 for them, assuming the compensation's high enough. If we put them in a defined benefit plan, now we're talking $132,000. In terms of their benefit, if I run this out, for 10 years to age 65, the profit sharing plan, I'm assuming a 5% growth here, they'd have about $700,000, whereas in the defined benefit plan, they'd have $2.1 million. So defined benefit plans are great solutions for those who have enough cash flow to make those larger contributions and might also like those larger benefits. Maybe this really is their retirement plan. Now, we can bring some certainty into a business owner's life with defined benefit plans, because here we know what the benefit will be, so we can target that exact number. They just have to keep up with the contributions. We can make everything guaranteed. We can go to a fully insured defined benefit plan if we want to take all the risk out of it. But even if we don't, we can make this very predictable. We know the number we're going to end up with when we get to the retirement age. We have the protection from creditors, and of course we get the current income tax deduction. So here's our little group again. If we did this as a traditional defined benefit plan, look at the contributions for Pat and Chris. Now they are different numbers because age drives the numbers here, but now we are up to $200,000 for Pat and $162,000 for Chris. Now employee two is older, so they're up to $23,000, but that relative to the amount we're putting in for Pat and Chris is not so much of a hindrance. Now, there are different kinds of plans. We have traditional defined benefit plans. We have fully insured plans. We have cash balance plans, which is another version of defined benefit. So obviously, we don't have time to talk about all of these this morning, but they all have the benefit that we can do these very large contributions to accumulate these large sums at retirement. Come on. All right, so going back to our little company here, they could do the profit sharing plan, which was the first plan we looked at. They could also do the defined benefit plan. They could do one or the other, or they could do both. If we did the profit sharing plan, that saved them $39,912 of taxes. If they do the defined benefit plan, that saved them $133,003 of taxes. If they did them both together, they would save $172,915 of taxes every year. So think about that 5-person company. This is a little 5-person company. Now, not everybody has the cash flow to do both plans. Maybe they just want to do a profit-sharing plan, but some companies do. And if that company doesn't know about this, they're losing all those tax dollars when we could actually save them almost $173,000 in taxes. That's a huge tax savings for that little company. So let's talk about guarantees for a minute while we have a little bit of time left before we look at questions. We can make this defined benefit fully guaranteed if we go to a fully insured plan. When it's a fully insured plan, the plan can only be funded with annuity contracts that meet the requirement, and you can have life insurance, although you don't have to, and life insurance, which has to be whole life. Both products have to be from the same company. But if we go to a fully insured scenario, now everything is guaranteed and we take the market risk out of the program. So this is not created by insurance companies. This was created by the Internal Revenue Service. There are only a handful of companies that still write these plans. National Life is one of them. But these plans can have those very, very large contributions, those very large benefits, up to $2.5 million for somebody, and be very stable, very protected, no market risk. We're funding based upon the underlying guarantees of the contract. So let's talk about adding life insurance to the plan as well. You know, we're able to do that not only in fully insured plans, but in any qualified plan that's not an IRA type plan. Should we? You know, why would we? Well, first, it's just the need for life insurance. You know, unfortunately, 3 out of 20 people will die before they reach age 65. And for those who don't make it, 100% will die thereafter, so someday the benefit will be paid. Sometimes we're putting life insurance in a qualified plan. If this business owner is really planning on having, let's say, that $2.5 million for retirement, but they don't make it there because they die along the way, maybe they're leaving a spouse behind who's relying on that money as well. We can make the plan self-completing by adding life insurance as a benefit into the plan. So the advantage here, we're paying all our premiums with pre-tax money, so we can get more insurance for the same amount of out-of-pocket dollars. We can make that plan self-completing, and these are always permanent policies, so that policy will continue after retirement and they can take it with them. And while the insurance is in the plan, we certainly want this out, but even while it's in the plan, if they die, the pure amount at risk of that life insurance is income tax-free to their beneficiaries. So we're paying the taxes, the premiums pre-tax, but the death benefit is still income tax-free. So a 412 candidate, you know, this is where we see lots of insurance, usually small, closely held companies, not too many employees, usually less than 5. They want those big deductions, and usually the life insurance has a lot of appeal here. So here's a look at our group again. We made them a little smaller, more typical 412. We saw Pat and Chris. We have 1 employee now. Their contribution, if they did this as a 412 with just the annuity, now we're up to $535,999 contribution, with only $10,000 of that being from the employee. If we add insurance to this plan, that contribution goes up to $696,807. You can see we're buying $3.7 million of life insurance on Pat, $4.6 on Chris. The employee gets some insurance too because we have to give insurance to everybody. But now we're up to very, very big dollars for this little 3-person company. At a total contribution of $696,000, the tax savings are $236,000. Excuse me, $914. So this plan only has a net after-tax cost of $459,893 for our owners to benefit from a contribution of $686,862. So tremendous leveraging on the money here. When we added life insurance to this plan, it did increase the contribution versus doing the annuity only. It increases it about $160,000. Now that's all deductible, so if we knock off about a third of that for the tax savings, their out-of-pocket cost to add that insurance is about $106,000. But look at the premiums. The premiums are $321,000. So just for the owners, it's $315,000. Think of the earnings they would have to have outside the plan to pay the taxes to net that $315,000 to buy that coverage. Here, they only need $106,000 to get that same coverage. Tremendous leveraging on the dollars. Go down. Move. There we go. Okay. So who is a good candidate for this? For any qualified plan, we're looking for small business owners that are profitable. You know, they want the deduction. They would benefit from that deduction. They have the cash flow to be able to make the contribution. They may be driven by a desire to save for retirement, or they may be driven by the tax deduction, or it could be a combination of both. Sometimes they want an employee benefit program. As I said, usually these are small companies with less than 10 employees, but we can do companies of any size. It's just the bigger the company gets, the more slices of the pie there are to hand out. So the drive tends to change when we get into bigger companies, into more of the employee benefit program. But certainly in those companies with less than 10, we can favor the owners. Sometimes they're looking to pass wealth on to the next generation, and this is a good way to accomplish that. And again, we have the protection from creditors. That can be a very valuable benefit to a lot of business owners. You know, they always hope the bad thing doesn't happen to them, but, you know, you never know who's coming down the line. Any business can adopt a qualified plan. It doesn't matter what their form of business is, sole proprietor, partnership, LLC, C Corp, professional corp, S Corp. It doesn't matter. All business entities get the same qualified plan choices and the same benefits and the same contributions. So it doesn't matter what their form of business is. Any business profitable with cash flow, wants to get those tax advantages, is a candidate. So in an ideal world, come on, slide if it would come up. I'm going to make it flash here. You know, you want to ask the employer, how much do you want to contribute? Who do you want to include in your plan? Who do you not want to favor? And you bring that back to us. We have a little simple one-page fact line. And, you know, we'll design a plan that gets as close to their idea as perfect as we possibly can, of course, staying within the rules. So how do you get started? You talk to business owners. If you have connections with CPAs, talk to them. We can help their clients. As I already said, we're on a deadline here for December 31 for them to get their deductions. And you don't need to know what kind of solution it's going to be up front. We just want to know, how big a deduction do you want? How much money can you work with? What would you like to accomplish? We need a census form completed. That means we need dates of hire, dates of birth, and salaries for all the employees. You get that to us. We work hand in hand with QPM, by the way, at National Life. So we'll work to design that plan. We'll send a proposal back to you. It's usually multiple designs, and hone it until we get the best one that fits that client's needs. You know, you go back, you present it to the client, we'll tweak it as need be. Sometimes we go back and forth until they choose the plan that they're really happy with, and then we move forward to implement that. It's a matter of just filling out we have an installation workbook and paying the installation fee, and then we get that plan set up, and they're ready to go and can make their contribution. It's a great way to enhance client relationships. It puts the client in a better tax position. They're happy. The CPA is happy. And you're happy too, because you get nice compensation. So with that, I know we had opened the board for questions. I don't know, Beth is monitoring those for me, so I'll be happy at this point to answer any questions that might have come in.
Hi, Mary. Well, we did have one question about the slides, and we will be able to send out the slides with a follow-up email tomorrow.
Okay, great. I would also tell everyone on the line, if they want to explore, you know, a possible case for a client, or even if they just have questions, certainly feel free to call me, email me, and I can send you that one-page fact line to get the information from the client. Just email me, and I'll send it right back to you.
Okay, I think we have another question coming in. Just a moment. Nope, I think that was it.
All right, so we actually finished ahead of time. That was the record. I know there was a lot of information to take in a very short amount of time, but just kind of step back and take a breath for a minute. There's great opportunity between now and the year end. You know, for those businesses who are successful, they would love to be able to get the deductions. There are lots of choices in plan types and plan design, and our goal always is to work with you and the client to put together the best possible design for them to meet their objectives. You know, we're trying to help the client. And if we run a design and it doesn't work for that client, it comes right out in black and white on a piece of paper. You see that it's costing the money instead of saving money. We do that analysis on every case so that that client can make, you know, an educated decision. Not just to be right for the client and to work for them and to work for you. So it's a partnership. We work with you and we work with the client so that everybody's getting to the end. So I encourage you to talk to business owners, talk to CPAs. We'll help you through the whole process. We're always there to support you. I'll get on the phone with you and the client, CPA, whatever, to try and help you move forward. You don't have to have all the answers. But great opportunities through the end of the year. The time is now, and I encourage you to just open the conversations and then let us help you.
Mary,
so with that,
we can answer. Mary, we do have a couple more questions that have come in. Let me see if we can get to a couple of these.
Sure.
One is, how long does it take to put all this together from start to finish?
Good question. And a lot of it depends on the client. So I'll give you the parameters. First of all, when we get the information, you know, it starts with a proposal. The proposal is usually turned around within a few days. When we get to the really, really super, you know, under the gun business time in December, it might take a day or two longer. Then once the client agrees that this is the design they want, and then the installation booklet has to be completed, that comes back to Pentegra. We will review it, make sure it's complete, seek out any information that's missing. We then write the plan document. We send it back to the client for signature. All of that is done electronically. We do everything electronically. And once they sign that, it comes back to us. That plan is now established. We will get a tax ID number for the plan. And once that is done, now they can make contributions. Accounts can be opened for that plan. So that's the process. Now, if everybody is really responsive and quick to turn around their part, I would say from start to finish, it's possible to complete that in about 4 to 5 weeks. But, you know, if the employer takes time before they get back to us either with questions or information, or we send them the signature pages and a week goes by and they don't turn them around, that obviously will lengthen the time. So the kind of the short window is, I would say, in that 4-week category. Most of the time, these will take at least 6 weeks, and they can go anywhere longer than that depending on how slow people are returned. But I would say, you know, if everybody's moving along as they should, you know, on average, figure a reasonable time estimate is 6 weeks.
And what is the deadline, Mary, for providing information to have a plan to begin January 1st of 2018?
For 2018, we're still writing, I'll do a two-part answer to that question. We can write a plan for 2017 that's effective for the whole year from January 1, 17 to December 31, provide that employer signs that plan document by December 31, they can have the plan for the entire year. There are a couple of exceptions to that. A safe harbor 401k is an exception to that. That deadline is October 1. For 2018, we can write plans anytime from here forward, again, to December 31 of 18 to be effective for 2018. 401ks you want to do either before the year opens or at the very early part of the year so that employees can defer for the entire year. But technically, we can set up a 401k, a safe harbor 401k, up until October 1 of the year that we are in. So that was kind of a long-winded answer to that question, but hopefully that was somewhere in there was the answer they were looking for. Okay,
very good. I think we will look at, let's see, we might have a few questions that might take a little bit longer to answer, and we want to be respectful of everyone's time. Let me just see. Don't most companies start and fund these plans for the current year in the last quarter of the year?
Yes. Typically, I mean, it's not everybody, but there's a huge influx of plans always in the last quarter of the year. Employers, if this is the first year to create the plan, they tend to wait until the last quarter, number one, because people procrastinate, but also because they don't really know what their profit picture is going to look until they kind of get into the last quarter, so they kind of hold off till they're confident as to how their year is really going to turn out. So very, very common, very typical that these plans are, in fact, established in the last quarter of the year.
All right. What are we investing the monies into? What vehicles?
The investments can be anywhere that you as their financial advisor and the client chooses. The exception on that answer is a 412 fully insured plan where it has to go into the level premium annuity and the whole life if you're using life insurance. But any plan other than that fully insured plan, employers are permitted to invest in pretty much any legitimate investment vehicle with the exception of some collectibles. There are some rules about real estate as well, but it depends on the type of plan. But typically, it'll be a mix of investment vehicles. You can use annuities. So annuities are in the mix. Maybe mutual funds, could be a brokerage account, a variety of funds. So any of those things are permissible, and as far as PENTalk is concerned, it doesn't matter to us where the money is invested. So that's really a decision between whoever's handling the funds, between the financial advisor and the client as to what they're comfortable with. The difference would be on a 401k where we have employees, then we start to talk about investment platforms, which is just a structure that enables the employees to access their accounts. But again, you'll typically have an array of mutual funds available on that platform, but may also have a broker. Do we have any more? Okay.
No, I think that's it. If there are other questions that come in, we'll make sure to answer. I'll have Mary answer them individually to you with a follow-up. Our email will go out tomorrow with a link to the recording to listen again, and we'll provide you with the slide deck.
All right, so thank you, everybody. Thanks for tuning in and taking the time to stay with us for 45 minutes. Feel free, please reach out to us with any questions. We're always happy to help. And we can provide the slide deck, questions, whatever, just reach out to us. And thank you for your time again, and have a wonderful day.